The number on the screen is mocking you. It represents a company you've come to understand, maybe even to admire. You've done the work, you've read the annual reports, you've studied the competitive landscape. You know deep in your bones that this is a wonderful business, a machine for generating cash, a fortress in its industry. And the price is fair. It's reasonable. It's justifiable by every metric you've learned. But it's not perfect. It's not the screaming, once-in-a-decade bargain you read about in the legends of investing. It's just fair. And so you wait. You tell yourself you're being disciplined. You're being patient. You're waiting for Mr. Market to offer you that one perfect price, a few percentage points lower, a final concession to your analytical prowess. You're waiting to squeeze out that last dollar. And according to the most successful investor in human history, you are making one of the most common, most insidious, and most profoundly costly mistakes in the entire world of finance. You are stepping over a mountain of future gold to pick up a penny today. This journey we are about to embark on is a fundamental reprogramming of the investor's mind. It is an exodus from the barren desert of bargain hunting for mediocre assets into the lush, fertile valley of owning wonderful businesses. The central principle, the genetic code for this entire philosophy, comes directly from Warren Buffett, a man whose success has been so immense and so prolonged that it defies simple explanation. He said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This single sentence is not a folksy platitude. It is a powerful algorithm for wealth creation, a shield against the self-destructive tendencies that plague 99% of market participants. It is the key to unlocking the true engine of compounding, and it is the final promise that if you focus on the quality of the asset, the price you pay today will, over time, fade into near irrelevance. We will deconstruct this principle into its 5 core pillars, transforming it from a mere quote into a tangible, actionable system for your own financial freedom. We will explore the anatomy of a truly wonderful company, dissect the fallacy of the perfect entry point, unlock the mathematics of long-term compounding, understand the unquantifiable value of management and moats, and finally, embrace the ultimate arbitrage in any market, human temperament. Prepare to change the way you see every stock price, every company, and every investment decision you will ever make for the rest of your life. Our first pillar, the very foundation upon which this entire philosophy is built, is the understanding of what truly constitutes a wonderful company. Before we can even begin to discuss price, we must first be able to distinguish gold from glitter. Price is a number on a screen. Quality is a durable economic reality. The common investor reverses this. They start with a screener, looking for low price-to-earnings ratios, for stocks trading below book value, for anything that seems statistically cheap. They find a list of fair or even poor companies at what they believe are wonderful prices. Buffett, especially after the profound influence of his partner Charlie Munger, learned to invert this process entirely. The first, second, and third question must be about the quality of the business itself. Only after that quality is confirmed beyond a reasonable doubt does the question of a fair price even enter the conversation. This shift from a price-first to a quality-first approach is the single greatest leap in Buffett's evolution as an investor, and the story that cemented this lesson in his mind involves one of the most delicious and simple products imaginable: boxed chocolates. The foundational anecdote that perfectly illustrates this monumental shift is the 1972 acquisition of See's Candies. At this point in his career, Buffett was still largely a disciple of his mentor, Benjamin Graham. He was a master of what he would later call cigar butt investing, the art of finding a discarded cigar butt on the street that had one final free puff left in it. He looked for companies that were so beaten down, so unloved, that they were trading for less than their net working capital. He was buying dollars for 50 cents, but the dollars were often tied up in mediocre businesses. They were fair companies at wonderful prices. Then See's Candies came along. See's was a family-owned California institution founded by Mary See in 1921. It had built a fanatically loyal customer base through a simple formula: high-quality ingredients, a nostalgic in-store experience, and a brand that was synonymous with tradition and trust. When you gave a box of C's as a gift, you weren't just giving chocolates, you were giving a statement of quality and affection. The company was put up for sale, and a friend of Buffett's recommended he take a look. Buffett and Munger dug in. They found a business that was truly remarkable. It required minimal capital investment. The brand was so powerful that it gave the company immense pricing power. Every year, they could raise the price of their chocolates, and customers wouldn't just accept it, they would happily pay it, because the emotional connection to the product transcended the price tag. The company generated about $4 million in pre-tax earnings and had tangible assets of only $8 million. The sellers were asking for $30 million. For the old Buffett, the Ben Graham disciple, this was an immediate non-starter. $30 million for a business with only $8 million in tangible assets. That was a price-to-book ratio of nearly 4-to-1. It was heresy. His entire training screamed that this was too expensive. He was prepared to walk away. His maximum offer was $25 million, a price the sellers had already rejected. This is where Charlie Munger changed the course of investment history. Munger, who had a much deeper appreciation for the qualitative aspects of a business, saw what Buffett was missing. He wasn't looking at the $8 million in assets on the balance sheet. He was looking at the tens of millions of dollars in economic goodwill locked inside the minds of every customer in California. He saw the pricing power, the customer loyalty, the brand, an intangible moat that was more valuable than any factory or storefront. Munger famously told Buffett, "You're gonna screw this up, Warren. We're never gonna find another business this good. This is the kind of business we should be buying." He pushed Buffett to abandon the rigid, quantitative framework of cigar butt investing, and to recognize that paying a premium for true quality was not a risk, but a requirement. Reluctantly, Buffett agreed to pay the asking price, which after some negotiation came down to $25 million, what they wanted all along, but a price that still felt astronomically high to Buffett at the time. He later said that if the sellers had held out for $30 million, he likely would have walked away, missing out on one of the greatest investments of his life. That $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital investment and was free to be deployed into other wonderful businesses. C's Candies became the prototype, the mental model for everything that came after. It taught Buffett that the most valuable asset a company possesses often doesn't appear on its balance sheet. It is the durable competitive advantage, the moat, that protects it from competition. It taught him that a business that can consistently raise prices without losing customers has a financial engine more powerful than any statistical bargain. The initial overpayment of a few million dollars was a rounding error compared to the decades of cash generation that followed. He had paid a fair price for a truly wonderful company, and it changed his entire approach to capital allocation forever. The underlying psychological principle at play here, the mental trap that Buffett nearly fell into, is a combination of anchoring bias and what we can call tangibility bias. Anchoring is our tendency to rely heavily on the first piece of information offered, the anchor, when making decisions. For Buffett, the anchor was the $8 million in tangible assets. His mind was latched onto that number, making any price significantly above it seem irrational and expensive. This is a classic problem for spreadsheet-driven investors. They anchor to book value, to a past stock price, or to a specific P/E ratio, and this anchor prevents them from accurately assessing the value of intangible assets, like brand power, network effects, or superior management. They are trying to measure a Rembrandt with a ruler. The tool is mismatched to the asset. The tangibility bias is a close cousin. Our brains are wired to give more weight to things we can see and touch. A factory, a pile of inventory, cash in the bank. These are tangible, easy to quantify. The collective goodwill of millions of loyal customers, the pricing power that comes from a beloved brand, the brilliant capital allocation skills of a CEO, these are intangible. They are abstract. Because they are harder to measure and slap a precise number on, many investors, especially those with a purely quantitative background, systematically undervalue them or ignore them completely. They suffer from a failure of imagination. Charlie Munger's genius was his ability to see the massive, tangible cash flows that would emerge from these intangible qualities. He understood that brand loyalty wasn't just a fuzzy marketing concept. It was a financial machine that translated directly into high returns on invested capital with minimal need for reinvestment. Buffett's purchase of See's Candies was the moment he overcame this cognitive bias, learning to pay for the invisible fortress, the moat, as much as for the visible castle. True quality investing requires you to value the story, the culture, and the customer's mind, just as much as you value the assets you can count. So how can we translate this into an applied mental model, a practical blueprint for our own investment decisions? The first step is to create a checklist for identifying a must pass before you even consider its price. First, and most importantly, you must identify a durable competitive moat. What protects this business from competition? Is it a powerful brand like Coca-Cola or Apple that creates a mental shortcut for consumers? Is it a network effect like Facebook or Visa, where the service becomes more valuable as more people use it? Is it high switching costs like the software your company uses, where the pain of leaving is greater than the benefit of a slightly cheaper alternative? Or is it a low-cost advantage like Costco or Geico, allowing them to consistently undercut competitors? You must be able to clearly articulate this moat and, crucially, provide evidence that it is getting wider, not narrower, over time. Second, analyze the company's financial performance, not just for 1 year but for a decade or more. The key metric is Return on Invested Capital, or ROIC. A wonderful company consistently generates high returns on the capital it employs in its business. A business that can earn 20% on its capital is a far superior compounding machine to one that earns 6%, regardless of the purchase price. Look for consistency and a strong upward trend. This financial metric is the tangible proof of an intangible moat. Third, evaluate the management. Are they honest and capable? The best way to do this is to read their own words. Go back and read 10 to 15 years of annual reports and shareholder letters. Do they talk candidly about their mistakes and what they learned? Or is every report filled with corporate jargon and blame shifting? Look at their track record of capital allocation. What have they done with the company's excess cash? Have they made smart, synergistic acquisitions, or have they squandered it on vanity projects? Do they buy back shares when the stock is undervalued, or do they issue them when it's overvalued? You are looking to partner with owner-operators who think like you, with a long-term perspective. This is a crucial element of any successful long-term investing strategy. Fourth, and this is a non-negotiable rule, the business must be simple and understandable. It must fall within what Buffett calls your circle of competence. If you cannot explain, in simple terms, how the business makes money and why it will still be making money in 10 years, you have no business owning it. This isn't about raw intelligence, it's about intellectual honesty. Stick to what you know. This simple filter will protect you from more danger than any complex financial model. Only after a company has passed all 4 of these rigorous tests, a durable moat, high returns on capital, superb management, and understandability, do you then proceed to the question of valuation. To truly appreciate the power of this model, we must examine its antithesis, the path of the 99%. This is the world of cigar butt investing that Buffett himself had to escape. The typical bargain hunter is obsessed with the past. They look for a stock that has been beaten down, anchoring on its previous high price and assuming it will revert. They find a company in a struggling industry, say a department store chain, trading at half of its tangible book value. They think, I'm buying assets for 50 cents on the dollar. How can I lose? They fail to ask the crucial question. Are those assets eroding in value every single day? Is that book value real? Or is the inventory going to be marked down? And are the storefronts in dying malls becoming liabilities? They are buying a melting ice cube and they are so happy about the discount they got that they don't realize it will be a puddle by the time they want to sell it. This is the classic value trap. The price is wonderful, but the company is fair, or more often, terrible. The problem with the cigar butt approach is that it requires a constant search for new butts. Your upside is limited to that one last puff, the pop from a terribly cheap price to a merely cheap price. You can never get the multi-decade compounding that comes from owning a truly wonderful business, because the underlying business itself is not growing or creating value. It's a strategy of one-night stands, not a long-term marriage. This approach leads to a portfolio of mediocre companies, constant churning, high transaction costs, and significant tax bills. It is a world of frantic activity with very little long-term progress, a treadmill of mediocrity that feels productive but ultimately leads nowhere. Finally, let's trace the direct financial connection. How does prioritizing quality over price manifest in your portfolio's growth? Let's take two companies. Company A is a fair company, a slow-growing industrial manufacturer. It earns a mediocre 6% return on its capital. Because it's so unexciting, it trades at a wonderful price of $50 per share, which is 50% of its $100 per share in intrinsic value. Company B is a wonderful company, a dominant software business with a powerful moat. It consistently earns a 20% return on its capital. Because of its quality, the market recognizes it, and it trades at a fair price of $100 per share, exactly its intrinsic value. The bargain hunter buys Company A. The quality investor buys Company B. Let's watch what happens over 10 years. Company A, earning 6% on its capital, grows its intrinsic value by 6% per year. After a decade, its intrinsic value has grown from $100 to about $179. If the stock price follows, the bargain hunter has turned his $50 into $179, a very respectable return. But now look at Company B. Earning 20% on its capital, its intrinsic value compounds at a blistering pace. After a decade, its initial $100 of intrinsic value has exploded to $619. The quality investor has turned his $100 into $619. He has created more than double the absolute wealth of the bargain hunter, despite paying double the price relative to intrinsic value at the start. The engine of the business itself, its ability to reinvest capital at a high rate, was infinitely more important than the initial discount. This is the financial magic behind Buffett's principle. The discount on a fair company is a one-time benefit. The high return on capital of a wonderful company is an annuity that pays you every single year, compounding your wealth at a rate the mediocre business can never hope to match. This understanding is the first and most critical step in your financial education. We have now established the non-negotiable foundation, quality first. But even when an investor identifies a wonderful company, a second, more subtle demon appears: the desire for the perfect entry price. This leads us to our second pillar, deconstructing the fallacy of the perfect entry and understanding why market timing is a loser's game. This is where the wisdom of a fair price truly comes to life. The average person, even after accepting the need for quality, will still hesitate. They find their wonderful company, they determine a fair price is, say, $100 a share. But the stock is trading at $105. And so they wait. They wait for a pullback, they wait for a dip, they wait for that magical moment when the market will offer them their prize at a slight discount to fairness. In doing so, they often wait forever, watching from the sidelines as the company's value continues to compound upwards, leaving them further and further behind. They are trying to time the market on a micro level, and in the process they miss the entire macro level move. The opportunity cost of this hesitation, this futile quest for perfection, can be catastrophic to long-term portfolio growth. The foundational anecdote that powerfully illustrates the wisdom of acting decisively once a fair price is identified comes from Buffett's investment in the Washington Post Company in 1973. This was a period of immense turmoil in the United States. The Watergate scandal was exploding, casting a shadow of uncertainty over the entire political landscape. The market was in the midst of a brutal bear market that would last for nearly 2 years. Fear was rampant. The Washington Post, as the newspaper at the center of the Watergate investigation was facing not just market headwinds but also political pressure from the Nixon administration. Its stock price, which had been as high as $38 a share, had collapsed. By mid-1973, Buffett was able to start buying shares for an average price of around $6.37 per share, when he had calculated the entire business was worth at least $80 per share. On the surface, this sounds like a wonderful price. But the key to the story is not that he got a bargain. It's that he didn't wait for the perfect bargain. The stock did not bottom out when Buffett started buying. The market continued to be pessimistic, and the price of his shares continued to drift downwards after his purchase. A less experienced, less confident investor would have seen this as a mistake. They would have panicked, or they would have kicked themselves for not waiting to get the absolute lowest price possible. Buffett was completely unperturbed. Why? Because his focus was not on the price fluctuation of the stock, but on the intrinsic value of the business. He knew he was buying a dominant media franchise, a near-monopoly newspaper in a major American city with a powerful brand and significant pricing power. He had determined its value was at least $80 per share. Buying it for around $6 per share provided a massive margin of safety. Whether the absolute bottom was $6 or $5 or $4 was a matter of complete indifference to him. He was not a stock trader trying to scalp a few points. He was a businessman buying a piece of an exceptional enterprise. He understood that the difference between buying at $6 and buying at $5 would be a rounding error over the long run, but the difference between buying at $6 and not buying at all would be a life-altering financial mistake. His investment of just over $10 million would eventually grow to be worth over $1 billion. He acted decisively when the price was clearly more than fair, and he completely ignored the subsequent noise. He refused to let the quest for a perfect price prevent him from making a wonderful investment. The psychological principles that drive this destructive desire for the perfect entry point are two of the most powerful and pervasive biases in behavioral finance: loss aversion and anchoring bias. Loss aversion, first identified by psychologists Daniel Kahneman and Amos Tversky, is the tendency for humans to feel the pain of a loss approximately twice as powerfully as they feel the pleasure of an equivalent gain. This has profound implications for investment decisions. When an investor thinks about buying a stock at $105, their mind immediately fixates on the possibility that it could drop to $100 tomorrow. The potential pain of that $5 loss, even if it's just on paper, feels far more threatening than the potential pleasure of it rising to $110. This fear of immediate loss, this buyer's remorse, paralyzes them. They choose the temporary comfort of inaction over the possibility of long-term gain, because inaction shields them from the immediate risk of being wrong. The immense but abstract opportunity cost of missing a decade of compounding feels less real and less painful than the sharp, immediate sting of buying a stock and watching it dip 5%. Anchoring bias, as we discussed before, plays a crucial role here as well. If an investor has been watching a stock for months and they saw it briefly touch $90 during a market dip, their mind anchors to that $90 price. They start to believe that $90 is the correct or fair price. When the stock recovers to $105 based on strong earnings, they feel like they've missed it. They refuse to buy at $105, not because their analysis shows it's overvalued, but because their mind is anchored to a historical and now irrelevant price point. They are haggling with the past, not investing for the future. This combination of fearing a small, immediate loss and being anchored to a past price creates a perfect storm of indecision, causing investors to stand on the platform, waiting for a train that has already left the station and is picking up speed. Overcoming this requires a conscious and deliberate shift in mindset, from that of a price watcher to that of a business owner. The applied mental model to overcome this paralysis is the price versus value framework. It's a systematic process to move you from hesitation to decisive action. The first step is to calculate a conservative range of intrinsic value for the business. Note the word range. Value is not a single, precise number, it's a fuzzy estimate. your goal is not to pinpoint it to the penny, but to determine a reasonable ballpark. For example, after your analysis, you might conclude that a wonderful company is worth somewhere between $120 and $150 per share. This range accounts for the inherent uncertainty of the future. The second step is to define your margin of safety. This is Benjamin Graham's greatest contribution to the world of investing. You want to buy at a significant discount to your estimated intrinsic value. However, the key here is to define this margin as a fair price zone, not a single point. For example, you might decide that you are willing to start buying when the stock price is at or below 75% of the low end of your valuation range. In our example, 75% of $120 is $90. So your fair price action zone is any price at or below $90 per share. The third and most critical step is execution. The moment the market price enters your predetermined fair price zone, you must begin to act. You don't wait for it to hit $80 or $70. The moment it hits $90, your plan is triggered. This removes emotion and hesitation from the equation. You are no longer making a gut decision in the heat of the moment. You are simply executing a rational plan you made when you were calm and objective. The fourth step is to use a strategy that mitigates the psychological pain of not buying at the absolute bottom. Instead of investing your entire intended amount all at once, you can scale in. Perhaps you invest 1/3 of your capital at $90, another third if it drops to $85, and the final third if it drops to $80. This approach, a form of dollar-cost averaging, turns subsequent price drops from a source of fear into an opportunity you planned for. You start to hope the price goes down so you can fill out your position at an even better price. This completely reframes the emotional experience of investing and allows you to take advantage of volatility instead of being frightened by it. This structured approach to investment decisions is a cornerstone of professional asset allocation. Let's contrast this with its antithesis, the path of the 99%, which is a vicious cycle of analysis paralysis. The typical investor finds a great company, let's say a technology giant like Microsoft. They do a mountain of research. They understand the business, they love the products, they believe in the long-term vision. They determine a fair price is around $300 per share. The stock is trading at $310. They wait. It climbs to $330. They curse themselves for not buying at $310. They tell themselves, I'll definitely buy on the next dip back to $310. The company reports fantastic earnings, and the stock jumps to $350. Now they feel even worse. They are frozen. A market correction finally comes, and the stock pulls back, but it only drops to $320 before finding support and heading higher again. Because their anchor price was $310 or lower, they don't act at $320. They are paralyzed by the gap between the market price and their, quote, perfect price. This cycle can repeat for years. Eventually, the stock might be at $500, and they are still waiting for a pullback to a price they will never see again, all while the intrinsic value of the business has been compounding away from them. They did all the hard work of identifying a wonderful company, only to fail at the final, simple step of pulling the trigger at a fair price. Their portfolio is filled not with stocks, but with regrets. The direct financial connection here is best illustrated with a simple, brutal calculation of opportunity cost. Let's imagine two investors in the year 2010, both with $10,000 to invest, and both have identified Amazon as a wonderful company. Investor A, the fair price investor, sees the stock trading at around $125 per share. His analysis tells him it's a fair, though not screamingly cheap price, for a business with such immense growth potential. He acts decisively and buys 80 shares. Investor B, the perfect price investor, also likes Amazon, but he's anchored to a recent low of $115. He decides to wait for the price to pull back 8% so he can get a better deal. He sets his buy order and waits. The pullback never comes. The stock consolidates and then begins its relentless march upward. Fast forward to today. Amazon stock, after splits, has increased astronomically. Investor A's initial $10,000 investment would be worth, depending on the exact date, well over $1 million. He has achieved staggering portfolio growth and genuine financial freedom. And what about Investor B? His $10,000 is still sitting in his account, maybe earning a tiny amount of interest. He spent a decade watching one of the greatest wealth creation vehicles in history from the sidelines because he was trying to save about $10 per share on his initial entry. The opportunity cost of his hesitation wasn't 8%. It was a life-changing fortune. The math is undeniable. The long-term growth of a truly wonderful business will dwarf any small savings you might achieve by haggling with the market for a perfect entry price. Your focus should not be on saving pennies at the point of purchase, but on capturing the dollars, the tens, hundreds, and thousands of dollars generated by years of business compounding. This brings us directly to the engine room of this entire philosophy, the mathematical force that makes all of this work. Our third pillar is understanding the overwhelming power of compounding in quality businesses, the engine that ultimately makes the initial purchase price fade into insignificance. Compounding is the eighth wonder of the world, but it is a force that only reveals its true magic under specific conditions, a long time horizon, and a high rate of return. Fair companies, the cigar butts, do not provide a high rate of return for the underlying business. You might get a one-time pop from the price correcting, but the business itself is stagnant. A wonderful company, on the other hand, is a compounding machine. Its intrinsic value is growing year after year at a high rate, and as an owner of that business, that growth accrues to you. This is the secret that separates the merely good investor from the truly wealthy one. They stop thinking about the stock and start thinking about the business as an engine, and their primary job is to find the best possible engine and let it run for as long as possible. The quintessential anecdote for this pillar is Buffett's monumental investment in the Coca-Cola Company in 1988. This was not a classic value investment in the way the Washington Post was. The market crash of October 1987 had certainly made stocks cheaper, but by 1988, Coca-Cola was not a beaten-down, forgotten company. It was one of the most famous and respected brands in the world. Its stock was trading at a price-to-earnings ratio of around 15, which was not particularly cheap for the time, especially for a company of its size. Many on Wall Street thought its best growth days were behind it. They saw a fair company at a fair price, maybe even a slightly expensive one. But Buffett saw something entirely different. He saw a truly wonderful company at a very fair price. He had been observing Coca-Cola for 50 years. He saw a product that was simple, relatively cheap, and created a share of mind with consumers globally that was practically unassailable. He saw a distribution system that was a work of genius, a global network that no competitor could ever hope to replicate. Most importantly, he saw a business that required very little tangible capital to grow. It was a royalty on the thirst of the world. He understood that the company could and would continue to grow its earnings steadily for decades to come, driven by population growth, international expansion, and small, consistent price increases. He wasn't buying the company's past performance. He was buying its next 50 years of global dominance. Between 1988 and 1989, Berkshire Hathaway invested over $1 billion to acquire a significant stake in Coca-Cola. He was paying what he considered a fair price for a business whose future was, in his mind, virtually certain. What happened next is a masterclass in the power of compounding. Buffett did nothing. He simply held the shares. The Coca-Cola business continued to execute its plan, expanding its global reach and consistently growing its earnings. The stock price followed. By the end of 1997, less than a decade later, Berkshire's initial $1.3 billion investment was worth over $13 billion. The dividends alone were returning a significant portion of his original investment each year, The initial P/E ratio he paid, the hand-wringing on Wall Street about whether it was too expensive, all of that became a forgotten footnote. The sheer power of the business's growth engine completely overwhelmed the specifics of the entry point. The lesson was profound. If you get the business quality right, and you have a long enough time horizon, the compounding of the business's intrinsic value will do all the heavy lifting for you. The most important investment decision wasn't the buy order in 1988, it was the decision to not sell in 1990, 1995, or 2005. The psychological bias that prevents most people from harnessing this power is known as hyperbolic discounting. This is our brain's built-in tendency to strongly prefer smaller, immediate rewards over larger, later rewards. It's why people choose to eat a slice of cake now, immediate pleasure, over the long-term benefit of good health, delayed reward. In investing, this bias manifests as an obsession with short-term gains. The immediate reward of buying a stock and seeing it jump 10% in a month feels much more satisfying and real than the abstract, far-off concept of a 1,000% gain over 20 years. This leads investors to a trader's mindset. They buy a fair company at a wonderful price, and as soon as it rises to what they deem a fair price, they sell to lock in their reward, that small, immediate hit of dopamine. In doing so, they voluntarily step off the compounding train just as it's starting to pick up speed. They trade the chance for life-changing wealth for the fleeting satisfaction of a small, quick profit. Buffett's genius is his ability to override this innate psychological pull. His time horizon is not next month or next year, it's forever. This long-term perspective allows him to fully discount the siren song of short-term rewards and keep his focus squarely on the massive but distant prize of decades-long compounding. To instill this long-term focus in ourselves, we can use an applied mental model called the 10-year test. Before you buy any stock, you must subject it to this simple but powerful thought experiment. Step 1. Completely ignore the current stock price and the daily market chatter. They are irrelevant for this exercise. Step 2. Ask yourself a single, critical question. Am I highly confident that this business will be earning significantly more money and will be a stronger, more dominant enterprise 10 years from now? This is not about predicting the stock price. It's about evaluating the long-term trajectory of the underlying business. Your answer cannot be a simple yes. You must be able to articulate time why died. What are the specific tailwinds? What is the evidence of its durable moat? Why will it thrive while competitors struggle? Step 3. If you cannot answer this question with a resounding yes and provide a clear, logical thesis to back it up, the inquiry stops. The company fails the test, and you do not invest, no matter how cheap the stock seems. If the answer is a clear yes, then you proceed to step 4. Work backwards from that future. Imagine the business is indeed 50% or 100% larger and more profitable in 10 years. The stock price, over time, will inevitably reflect that reality. Now think about today's price. A 5% or 10% difference in your entry point today will be a trivial, unnoticeable blip in the context of that massive long-term value creation. This test forces you to shift your perspective from that of a stock picker to that of a business owner. It reframes the purchase not as a short-term trade, but as a decade-long partnership with a growing enterprise, making the initial price a secondary consideration to the quality of your long-term partner. The antithesis of this patient, compounding-focused approach is the trader's mindset, the path walked by the vast majority of market participants. The trader is not concerned with 10-year plans or competitive moats. Their world is measured in days, hours, or even minutes. They are playing a game of price, not a game of value. They buy a mediocre company not because they want to own it, but because they believe its price will go up in the short term, allowing them to sell it to someone else, the greater fool. Their portfolio is a revolving door of positions. They chase hot trends. They react to news headlines. They are perpetually trying to outsmart the market's next move. This strategy is a guaranteed path to mediocrity for several reasons. First, it incurs massive costs. Every trade generates a commission, and every realized short-term gain is taxed at a much higher rate than long-term gains. These costs act as a constant, heavy anchor on portfolio growth. Second, it is psychologically draining, demanding constant vigilance and leading to emotional fear and greed-driven decisions. Third, and most importantly, it completely misses the primary source of wealth in the stock market, the long-term compounding of value in great businesses. The trader is so busy scalping for pennies on the train tracks that they fail to see the multi-ton freight train of compounding bearing down on them, the one that the patient investor is riding in first class. The direct financial connection here is where the argument becomes undeniable. Let's create a clear mathematical picture. Consider again our wonderful company that generates a 20% return on its invested capital, ROIC. For simplicity, let's assume it pays no dividend and reinvests all its earnings back into the business at that same 20% rate. This means the intrinsic value of the business itself is compounding at 20% per year. If you buy a share for $100 today, the underlying value supporting that share will be $120 next year, $144 the year after, and so on. After 20 years, the intrinsic value of your single share will have grown to over $3.800. Now, let's consider the trader who buys a fair company with a 6% ROIC. He buys it at a wonderful price of $50 when its intrinsic value is $100. A year later, the market recognizes its mistake, and the price rises to its fair value, which has now grown by 6% to $106. The trader sells, booking a fantastic one-year gain of 112%. He feels like a genius. But now what? He has to find another similar opportunity. And another. And another. The chances of consistently finding and perfectly timing these trades are infinitesimally small. Meanwhile, the owner of the wonderful company did nothing. He just sat there while his initial $100 investment became $3.800. The active trader made a one-time profit by closing the valuation gap. The patient owner made a fortune by harnessing the power of the business's internal compounding engine. This is the ultimate secret to beating the market. You don't beat the market by outsmarting it every day. You beat the market by buying its most exceptional businesses at fair prices and letting them do the work for you over decades. We have established the need to identify quality and the wisdom of acting at a fair price, powered by the engine of compounding. But what are the deep, underlying sources of that quality? It's not just about numbers on a spreadsheet. This leads us to our fourth pillar, recognizing that when you buy a stock, you are paying for unquantifiable assets, namely, the strength of the company's protective moat and the integrity and skill of its management. These qualitative factors are the true bedrock of a wonderful company. They are the invisible engines that produce the beautiful numbers that analysts later admire. Paying a fair price is often really about paying a premium for these difficult-to-measure yet critically important attributes. Most investors focus on what is easy to count, but the greatest fortunes are made by understanding what truly counts. The perfect foundational anecdote to illustrate the value of these intangible assets is not a high-tech giant or a global brand, but a humble furniture store in Omaha, Nebraska. The story of Buffett's acquisition of Nebraska Furniture Mart is a legend in the world of business. The store was founded in 1937 by a Russian immigrant named Rose Blumkin, known to everyone as Mrs. B. With a $500 loan, she built the business into the largest and most successful home furnishing store in the country, all based on a simple, ruthless philosophy: sell cheap and tell the truth. Her business acumen was extraordinary. She was a brilliant buyer, a tough negotiator, and had an obsessive focus on efficiency and customer value. By the 1980s, Nebraska Furniture Mart was generating hundreds of millions of dollars in sales and was a local institution. In 1983, Warren Buffett decided he wanted to buy the company. He went to meet the then 89-year-old Mrs. B. He asked her a few questions, observed her passion and intelligence, and quickly realized he wasn't just buying a retail business, he was buying a commercial miracle built by a unique genius. He asked her what her price was. She named a number, around $60 million. Buffett agreed on the spot. He wrote a check. The entire deal was done on a handshake, with a one-page contract. Most remarkably, Buffett did not conduct an audit of the company's finances. He did not send in teams of accountants to verify the inventory or check the receivables. He told Mrs. B, "If you tell me the numbers are X, they're X. I trust you." Why would a famously careful investor do this? Because he understood that the true value of Nebraska Furniture Mart was not in its inventory or its real estate. It was in the business culture Mrs. B had created, her unassailable reputation for integrity, and the brilliant management of the Blumkin family who would continue to run the business. He was buying an economic moat built on operational excellence and customer trust, and he was buying a management team whose interests were perfectly aligned with his own. He paid a fair price not for the assets on the balance sheet, but for the character and competence of the people running the show. Years later, he would say that buying Nebraska Furniture Mart was one of his best ever investment decisions, one that taught him that when you find truly exceptional management, it is an asset worth paying a significant premium for. The psychological traps that prevent most investors from appreciating these qualitative factors are the fundamental attribution error and the halo effect. The fundamental attribution error is our tendency to overemphasize personality-based explanations for behaviors observed in others while underemphasizing the role of situational influences. In investing, this often works in reverse. Investors attribute a company's success purely to broad industry tailwinds or a hot market, situational factors, and fail to give proper credit to the specific, brilliant executive decision-making that navigated those conditions. They might say, of course that software company did well, the whole sector was booming, without recognizing the CEO's genius capital allocation that set it apart from its dozens of failed competitors. They fail to see the jockey, focusing only on the horse and the track. The halo effect is the tendency for an initial positive impression of a person, brand, or company to influence our feelings and thoughts about their other attributes. For example, because we love our iPhone, we might unconsciously assume that Apple's corporate governance is perfect, that its future projects are all guaranteed to succeed, and that its management can do no wrong. This can be dangerous. Buffett's approach is a more nuanced inversion of this. He seeks to understand the source of the halo. He doesn't just admire the great brand. He digs deep to understand the management decisions and the structural moat that created and sustained that brand. The average investor is seduced by the halo. The master investor dissects it to see if it's real and sustainable. Paying a fair price for a company with a strong halo is only wise if you have confirmed that the halo is the result of a brilliant jockey and a powerful structural moat, not just temporary good fortune. This leads to our applied mental model for this pillar, the CEO litmus test. This is a practical guide for evaluating the unquantifiable asset of management, a crucial step in any quality investing framework. First, become a business historian. Go to the company's website and read every single annual shareholder letter the current CEO has written. Read them chronologically. You are looking for several things. Is the language clear, simple, and direct? Or is it filled with obfuscating jargon and buzzwords? A CEO who writes clearly usually thinks clearly. More importantly, how do they discuss failures? Do they take personal responsibility, explain what went wrong, and detail the lessons learned? Or do they blame the economy, the competition, or one-time charges? Honesty in failure is a powerful signal of integrity. Second, analyze their capital allocation decisions. The CEO's most important job is deciding what to do with the company's profits. Trace their history. When the stock price was low, were they aggressively buying back shares, or were they making expensive, headline-grabbing acquisitions? When they did make acquisitions, did those deals add real, long-term value, or were they diversifications into unrelated fields that destroyed shareholder value? Look at their dividend policy. Is it consistent and sensible? You want a CEO who thinks like a rational owner, whose primary goal is to increase the long-term per-share intrinsic value of the business. Third, look for evidence of a long-term focus. Does the CEO talk incessantly about hitting quarterly earnings estimates, or do they talk about building the business for the next decade? Are they investing in research and development and other long-term initiatives, even if it hurts short-term profits? A manager obsessed with the daily stock price is managing for Wall Street. A manager obsessed with the long-term health of the business is managing for you, the owner. This deep dive into the words and actions of management is a form of due diligence that 99% of investors will never do, and it provides an enormous edge. The antithesis of this approach is the spreadsheet investor. This individual lives and dies by their financial models and stock screeners. They are searching for quantitative perfection. They screen for stocks with P/E ratios below 10, price-to-book ratios below 1, and dividend yields above 5%. Their screen spits out a list of companies. They might find a legacy telecommunications company with a high dividend yield but a mountain of debt, declining revenue, and a management team that has been making poor acquisitions for a decade. The spreadsheet says buy. It's statistically cheap. But the spreadsheet cannot measure the rot within the business. It cannot quantify the incompetence of the CEO or the fact that the company's technological moat is rapidly evaporating. The spreadsheet investor buys the stock, collects a few dividends, and then is shocked when the company is forced to cut the dividend, the stock price collapses, and their wonderful price turns into a permanent capital loss. They ignored the most important factors because those factors couldn't be neatly placed into a cell in Excel. They valued what could be measured and in doing so missed what mattered most. The direct financial connection between quality management and portfolio growth is profound and undeniable. Let's imagine two identical companies in the same industry, Company A and Company B. Both generate $100 million in free cash flow this year. The CEO of Company A is a promoter type. He's focused on short-term appearances. He uses the $100 million to make a splashy, overpriced acquisition in a trendy new industry. The deal gets good press, but it's a poor strategic fit and generates low returns on capital. The CEO of Company B is a master capital allocator. He sees that his company's own stock is undervalued. He uses the $100 million to repurchase a significant number of shares. The next year, both companies again generate $100 million in operating profit. But for Company B, that profit is now divided among fewer shares. The earnings per share, EPS, for Company B is now significantly higher than for Company A. Over 5 or 10 years, this difference in capital allocation strategy creates a massive divergence. Company A becomes a bloated, inefficient conglomerate with mediocre returns. Company B becomes a lean, focused cash machine whose per-share value has compounded at a much higher rate. The stock price will eventually reflect this reality. The initial fair price an investor paid for Company B, which included a premium for its brilliant CEO, turns out to be a spectacular bargain, while the cheap price paid for Company A becomes a cautionary tale. The skill of the management team is a hidden multiplier on all future earnings. We have now journeyed through 4 critical pillars. We know we must identify wonderful companies, act decisively at a fair price, trust in the long-term power of compounding, and pay a premium for the unquantifiable assets of moat and management. But all of this collapses without the final, binding element. Our 5th and final pillar is the realization that the ultimate arbitrage, the ultimate edge in investing, is not analytical brilliance, but temperament. Patience, discipline, and the ability to control one's own emotions are the final promise. The ability to pay a fair price and then do nothing for a very, very long time is the rarest and most valuable skill in finance. It is this emotional fortitude that separates the temporary winners from the multi-generational wealth builders. The foundational anecdote for this pillar is not a single transaction, but the entire, sprawling history of Berkshire Hathaway itself. The true genius of Warren Buffett is not just in what he buys, but in what he holds. Consider his investment in American Express in the 1960s. The company was facing a potential catastrophe known as the salad oil scandal. A major customer defaulted on massive loans secured by fictitious barrels of salad oil, and Wall Street panicked, believing the potential losses would bankrupt American Express. The stock price was cut in half. Buffett, instead of panicking, did his homework. He went to restaurants and banks, observing that customers and merchants were still using American Express cards and traveler's checks. The scandal had damaged the balance sheet, but not the fundamental consumer moat. He invested 40% of his partnership's capital into the company at a wonderful price born of crisis. But the real story is what happened next. He held it. And held it. And held it. He did the same with Wells Fargo, buying during banking panics and holding through controversy. He did the same with Coca-Cola, holding through the new Coke fiasco. He did the same with Apple, holding through trade war fears and supply chain disruptions. In every case, the initial purchase required analytical skill, but the creation of immense wealth required something else entirely, a temperament of granite. It required the patience to allow the wonderful business to recover and continue its compounding journey, ignoring the deafening screams of fear and panic from the market. His greatest returns came not from brilliant trading, but from disciplined inaction. The underlying psychological principles that make this so difficult are myopic loss aversion and action bias. Myopic loss aversion is a combination of the loss aversion we've already discussed and a tendency to evaluate our outcomes frequently. The more you check your stock portfolio, the more you will experience the volatility of the market. Since we feel losses more keenly than gains, this frequent checking leads to a constant state of anxiety and a high probability of making a fear-based decision, like selling a great company during a temporary market downturn. You are subjecting yourself to a death by 1,000 paper cuts of emotional pain, which inevitably leads to a bad decision. Action bias is the human tendency to favor action over inaction, even when inaction is the more rational course. In the face of uncertainty or a problem, our brains scream at us to do something. When a stock we own drops 20%, our instinct is to act, either to sell it to stop the pain or to buy more without re-evaluating the thesis. The idea of simply doing nothing, of calmly sitting on your hands while the storm rages, feels unnatural and irresponsible. Yet for the long-term owner of a wonderful business, doing nothing is very often the most profitable action you can take. Buffett's superpower is his masterfully engineered inaction. He has structured his life and his business to insulate himself from short-term noise, allowing him to operate on a time horizon that is inaccessible to most people. He is playing chess while the rest of the world is playing checkers, and the key difference is his ability to think many moves ahead and not react to his opponent's every twitch. So how can we cultivate this temperament? We can use an applied mental model I call the glacier mindset. Glaciers are an unstoppable force of nature, but their movement is slow, patient, and imperceptible on a day-to-day basis. You must manage your portfolio with the same immense patience and long-term perspective. Step 1 is to reframe your ownership. The moment you buy a stock, stop thinking of it as a stock. Think of yourself as a silent partner in a private business. You wouldn't sell your stake in a successful local pizza shop because of a bad week of sales or a gloomy economic forecast. You must afford your public companies the same courtesy. Step 2 is to create a, quote, decision journal. Before you buy any stock, write down in detail your thesis. Why are you buying it? What are the key drivers for its success over the next 10 years? What would have to happen for your thesis to be proven wrong? Be specific. Then, put it away. This journal serves two purposes. It forces you to think through your decision rationally from the start, and more importantly, it becomes your anchor during market storms. When the stock drops and you feel the urge to panic sell, you are required to first reread your journal entry. Has your original thesis been fundamentally broken? Has a competitor permanently destroyed the moat? Has management become dishonest? If the answer is no, and the price is just falling due to general market fear, then your journal commands you to do nothing, or perhaps even to buy more. Step 3 is to create hard and fast rules for selling. For example, you might commit to only 3 reasons to sell. 1. Your original thesis is proven fundamentally wrong. 2. You have found a demonstrably superior investment opportunity and need the capital. 3. The stock has become so overvalued that its future expected returns are dramatically lower than safer alternatives like government bonds. Notice that the stock price went down is not on the list. Step 4, and this is the most practical advice, radically reduce the frequency with which you check your portfolio. Turn off the stock ticker on your computer. Delete the brokerage app from your phone's home screen. Commit to checking your portfolio once a week or even once a month. By creating informational distance, you are giving yourself the emotional space to operate like a glacier, not a hummingbird, cultivating the temperament necessary for successful long-term investing. The antithesis to this patient mindset is the get-rich-quick gambler. This person is the embodiment of impatience. They are not investing. They are chasing lottery tickets. They jump from meme stocks to speculative cryptocurrencies, always searching for the next 100x return in a week. They are obsessed with the daily, hourly, and minute-by-minute fluctuations of price. Their emotional state is a direct reflection of the last tick of the market. They cannot comprehend the idea of buying a wonderful company and holding it for 20 years. To them, that sounds boring, slow, and pointless. Their portfolio is a chaotic graveyard of failed trades, high commissions, and painful tax bills. They are perpetually generating action, but never building wealth. They are caught in a cycle of hope and despair, driven by the most primitive emotional instincts of fear and greed, and are the primary source of profit for the patient, disciplined investors who are on the other side of their frantic trades. The direct financial connection of temperament is the final, brutal proof of this entire philosophy. Let's quantify the cost of impatience. First, there are taxes. If a gambler buys and sells a stock within a year, any gain is taxed at the high short-term capital gains rate, which can be nearly double the long-term rate. A patient investor who holds for more than a year pays a much lower tax rate, allowing their capital to compound more efficiently. Over a lifetime, this difference is monumental. Second, there's the cost of being wrong. The patient investor, holding a basket of wonderful companies, only needs a few big winners like Coca-Cola or Apple to generate incredible wealth for the entire portfolio. The impatient trader needs to be right constantly, when to get in, when to get out, and a few bad trades can wipe out dozens of small wins. But the most significant cost is opportunity cost once again. Take a company like Microsoft. Imagine you bought it at a fair price in 2010. A get-rich-quick trader might have sold it for a 50% gain in 2011 and felt brilliant. A patient owner who simply held on would have seen their investment increase by more than 1,000%, not including dividends. The difference in financial outcome is not just large. It's the difference between a nice profit and multi-generational wealth. Temperament, the ability to patiently hold on through the inevitable volatility, is the final, non-negotiable ingredient. It's the ultimate arbitrage, because in a world obsessed with speed and instant gratification, patience is the scarcest and therefore the most valuable commodity of all. You have made it through the crucible. You have invested your time and your focus, and in return, you have acquired a powerful mental tool, a new lens through which to view the world of investing. You now possess the framework that Warren Buffett and Charlie Munger used to build the most formidable financial fortress in modern history. You understand that the frantic search for a bargain price in a mediocre asset is a fool's errand. The true path to financial freedom lies in identifying wonderful businesses, paying a fair price for their quality, and then harnessing the patient, inexorable power of long-term compounding. You have learned to escape the paralysis of waiting for the perfect entry, to value the invisible assets of management and moat, and to recognize that the final, decisive battle is not fought against the market, but against the impatient, fearful instincts within yourself. This is a profound transformation. But this knowledge, as powerful as it is just one critical piece of a much larger interconnected system, You have mastered the principle of asterisk what to buy and ties when to pull the trigger. But this is just a single node in a complex network of mental models required for sustained success. Understanding the fair price for a wonderful company is the key to entering the game correctly. But what about the rest of the game? How do you know when to sell? How do you manage a portfolio of these wonderful companies? How do you size your positions to maximize returns while managing risk? How do you learn from your inevitable mistakes and turn losses into tuition for future gains? The principle you have just mastered is a powerful weapon, but an arsenal requires more than one. The video that is now appearing on your screen is not a random suggestion. It is the next piece of the map. It is the component that links the principle of buying with the discipline of portfolio management. It is the bridge between identifying a great asset and constructing a resilient, anti-fragile financial life. The journey you are on is a conscious ascent from an amateur speculator, tossed about by the whims of the market, to a disciplined, intelligent capital allocator who is in control of their own destiny. The choice to click is not about watching another video. It is a conscious decision to continue that ascent. It is a commitment to completing your mental arsenal, to forging the next link in the chain of your financial education. The choice is yours. Complete the map.